All right, let's get right into it. Today, we're looking at the story of Thule Group from an investor's point of view, and wow, what a story it is. We're talking about a really dramatic journey through the last business cycle, a massive pandemic driven boom, a super painful bust, and really a masterclass in how to navigate a crisis. At the heart of everything Thule does is this simple motto. They've built this incredibly powerful premium brand that people all over the world know and trust for their adventures. It's a name that just screams quality, safety, and that classic, clean Scandinavian design. And that right there is the big question we're tackling. This isn't just about roof boxes and bike racks. This is really a financial case study in what happens when a top-tier company gets caught in a once-in-a-generation demand shock and how it managed to fight its way back.
So, to really get the drama, you first have to understand the business itself. Thule's strategy is pretty fascinating. They don't try to be everything to everyone. Instead, their whole philosophy is to be big in pockets. So what does big in pockets even mean? Well, it means they find these very specific product niches and then they just completely dominate them. You can see it right here in the chart. Their core business, sport and cargo carriers, the roof racks and bike carriers, that's almost 60% of their sales. This intense focus gives Thule incredible power in the market. But as we're about to see, it also created a very concentrated risk that was about to be put to the test. And that brings us to the main event. What I'm calling the Great COVID Whiplash. This is where the story gets really wild, throwing this stable, market-leading company into just an extreme period of boom and then bust. You can see the whole roller coaster ride right here on this timeline. In 2020 and 2021, when basically everyone rushed outdoors, demand just went vertical. Sales exploded by a record-breaking 32.7%. But then, the music stopped. As the world started to open back up, that demand cooled off just as fast, which led to this sharp 2-year downturn. I mean, the scale of this reversal was just staggering. If you adjust for currency, the company swung from almost 38% growth in 2021 to a really painful 15% decline just 2 years later. That pandemic tailwind had flipped into a massive headwind, and it was all because of an inventory crisis happening with their retailers. Now, it's really important to understand this part. The problem wasn't that you and I stopped buying Thule products. The real issue was this classic supply chain problem called the bullwhip effect. Basically, retailers, who had ordered a mountain of stuff thinking the boom would go on forever, suddenly slammed on the brakes to clear out their own warehouses. And when they stopped ordering, Thule sales just fell off a cliff. So the big question is, how did management deal with this massive downturn? For any investor, this is the ultimate test. It shows you what a company's leadership is really made of. And this right here reveals a really critical strategic choice. With profits collapsing, the easy thing to do would have been to just slash costs everywhere. But Thule's management did the exact opposite. They protected their most important asset, their product innovation, by actually increasing R&D spending as a part of their sales. They chose to sacrifice short-term profits to protect their long-term future. At the same time, on the operational side, they became laser-focused. The number one priority was to attack their own swollen inventory levels. The entire company shifted its mindset from make as much as possible to let's manage our stock and get it down. And the payoff for that discipline was huge. By selling down all that excess inventory over 2 years, the company unlocked a massive amount of cash that had just been sitting on its balance sheet, 1.2 billion Swedish kroner to be exact. Okay, now for an investor, this is where the real story is. Look at the cash flow. While the profits on paper were hurting, the company's ability to actually generate cash recovered to record levels. This proves that underneath it all, the business was still incredibly healthy. In a situation like this, cash flow was a much, much better sign of strength than profits were. So, after weathering that storm, management didn't just go back to the old way of doing things. They took the lessons they learned from that whiplash and laid out a really clear strategy to not only drive growth, but to build a stronger, more resilient company. This 4-point plan is basically their roadmap. It's about doubling down on what they do best, which is innovation, while at the same time moving into new areas that aren't so closely tied together. They're growing in categories like dog transport and car seats, and they're really focused on building a direct relationship with their customers online. And this acquisition really shows their new way of thinking. When they bought Quad Lock, they weren't just buying a new product.
They were buying a successful brand that was born on the internet with a powerful direct-to-consumer business model. The whole goal is to use what Quadlock knows to speed up Thule's own digital journey.
Okay, so that brings us to the final section where we put on our investor hat and ask the big questions for anyone looking at Thule today, now that all the dust has settled.
Looking at the valuation, one thing just jumps right out. Whether you're looking at EV/EBITDA or the PE ratio, which are really just different ways to measure how expensive a stock is, Thule is consistently more expensive than its competitors. The market is basically saying, yep, this is a higher quality business, and we're willing to pay a higher price for its great brand, its market position, and its higher profits. So is that high price tag justified? Well, the first question you got to ask is, how strong is their competitive advantage, their moat? And the answer seems to be, it's very strong. It's not just one thing, it's this powerful combination of a premium brand, a huge global distribution network, and an innovation engine that just keeps pumping out award-winning products. It creates this cycle that's just really, really hard for anyone else to break into.
And can they keep charging those premium prices? All the evidence points to yes. The most convincing proof is how quickly their gross margin recovered to an all-time high in 2024, even with all the inflation going on. That tells you that customers are absolutely willing to pay more for the quality and safety that the Thule name represents.
So we've seen the whole picture now, the boom, the bust, the smart response for management, and their strategy for the future.
And it all comes down to this one single question. Is a premium company like Thule, with its proven ability to bounce back, worth paying a premium price for, especially now that a lot of that recovery is probably already reflected in the stock price? Answering that, well, that's the heart of the investment case for Thule Group today.